Hello, everyone. It's Dustin, and thank you again for coming back and watching another video from Operation Tradefront. And today we're talking about the bloodbath. Yes, the bloodbath finally had a market. Now it's not as bad as back in March, but it was a bloodbath nonetheless. All right, so look at how much red we have here. Bleeds it back, wipes out 1, 2, 3, 4, 5, almost 6 days of trading in one day. So I've been wanting to talk about a few things over this week, and I haven't been able to put up a video until today, but I finally want to touch on some of the things that I wanted to talk about. I did see this coming, and a lot of different outlets that you could look at. Everybody was saying, when is the market going to retrace? When is the market going to retrace? We're overextended. We're overextended. So today I want to talk about 3 points that go into all of that, or touch on that as we talk about your trading/investing career. And this information, though very brief, your investing life does depend on it. You need to know these 3 things. So let's get right into them. And number 1, I want to talk about fundamentals versus technicals. So with fundamentals are news about a company, things about the company that is made public or talked about in public, or the details behind the business, their debt to equity ratios, and all sorts of stuff like that. Fundamentals are very important when it comes to investing in the long run. You don't want to invest in a company that has a ton of debt on their balance sheets, or because they may be insolvent and they may not be around for many years. So you don't want to invest in a company, because investing is long term, and we'll talk about that in a minute. However, you would potentially trade a company that has bad fundamentals, because when you're trading, you're in and out real quick. And again, we'll talk about that. But the technicals of a company is what you see in front of you here, the chart. So when I trade, I primarily trade off technicals. I look at the chart and I look at what's going on with the company. Now, if I hear news, like we just had NVIDIA in the news a couple of days ago with their new chips and stuff like that, and you can make plays off of fundamentals as well, but a lot of times when I myself am trading, I'm simply trading based off of technicals. Now, right here, you'll see this chart's pretty clean, because I took everything off, I hid everything, and I'll bring everything that I drew on here in just a minute. But let me back it out a little bit and see if I can get this. Let me hide these. Nope, I'm not going to be able to do it. Can get a little bit. Okay, well, I'm not going to be able to get it all. So we'll just go back here. So as you can see the date here, March 23rd, we sold off hard with the SPY because of everything. And then we've been climbing back. You can see it's been bounding and everything. And I've talked about this EMA before, and the 50-day EMA. And you see we came all the way back down here, and then we came back to the EMA. We rode it a little bit and then pulled up a little bit and then came back down. I've talked about coming back to the EMA before, the EMA acting like a magnet. So when this started pulling away, multiple things told me that this was going to be a somewhat harsh pullback. It still may be worse than it is. You can see we got a little bit of buying pressure here. So we have this longer wick down here, but we'll have to see what happens tomorrow. But I could see, we had smaller bodies on the candles when we were going up, and bigger red candles and stuff here and there. But I wasn't real sure what was going to happen. When I saw this gap up, I was like, okay, this could be it. We'll just have to wait and see. And I did make a play on this, on my account on the tracker on September 2nd, which is this candle here. I did sell call spreads instead of put spreads. In my previous video, I talked about selling put credit spreads. And here, let me turn this on. It's going to get a little jumbled here. There we go. All right. So this is what my chart looks like, because I have so much stuff on it. But you can see we were in this channel. We were trading this channel when we started rebounding. So we had this real wide channel. We had more volatility. And then we shrunk down to this lower channel. And when we shrunk down to this lower channel, you can see, as I talked about before, all of these are my trades profit window of my trades when I traded. All of these are put credit spreads all the way up through here. And then you'll see here, I flipped up here and done a call credit spread yesterday. I actually added another one today, but I need to add it in there. But the trade, so this is what I saw on my chart as these trades were playing out. And you'll see I drew these lines right here. So you can change between multiple time frames. I like using the daily, the 4 hour, the 1 hour, and then all the way down to the 1 minute if I'm trading intraday trying to see what's going on. On the daily, you can see that we gapped up here, but in the day yesterday, I was watching and I could see it was kind of a whipsaw day. It was up and down and up and down. I feel like I had whiplash at the end of the day. So when I was watching it and I saw what was going on, when we gapped up here, I saw some of the movement that we had with the green hammer with this long handle. It's a hammer candle, and the red candle afterwards, and then we started coming up. So when that was happening, I drew on these lines, and it was forming an upper or an ascending wedge. And so I was like, okay, this wedge is going to compact. It may be into today, or it may, this may be it today, which it came all the way up here, and I was like, okay, we may be out of it, and then it may come back over here or something. So and this was when I sold that call credit spread, sorry. And I was thinking it may trade into today up into here, but the further this goes out, the closer these two lines get, and the closer they get, the more compressed it gets. And then once that's done, it's either going to break up or break down. Generally, with an ascending wedge like this, it breaks down, which is exactly what happened here. And as you can see, we've sold off hard down through here, and this red bar here is a window for an iron condor that I have. I was worried because I was out of the money, and now it's back down in. Now I'm going to watch what it does the next couple of days and see if I want to close this out early or not. But one of the things that I want to mention here, and we'll have to wait and see what tomorrow brings, but we're in this channel here, this smaller channel, and you can see this bigger channel kind of cuts off right here, but it would extend on up through here as well. With this wick, we were down below the channel and then we came back up. I normally, when I try to draw my lines, I try to use the bodies of the candles. I will use wicks as a touch point, but I try to go off of bodies and let wicks overhang. So in this, if this bounces tomorrow and keeps this channel, then we're going to start going back up. And if it doesn't, then we're out of this channel and we're breaking down. So I talked about resorting to trading the credit spreads on the SPY on the call side and the put side, or maybe even the condor side like I'm doing here with this one. But if it breaks this channel, I'm not going to trade until I know what the stock is going to do or what the ETF is going to do. I'm going to keep an eye on it until I have an idea of what it's going to do with setting up another pattern. So we'll have to see what happens tomorrow. If we open red and drop, it could be bad. If we open red and climb back up, then we're still in the channel and we can continue to trade on up. And it has had this pullback, and it could have a much larger pullback than this. I'm not saying that it can't. One thing I want to talk about too here, you can see this box that I drew here. We've been way overbought back since the 21st, and now we're back down into the region, of the normal area, I guess you'd say. The last time we overbought back here, you can see we sold off from the top of the channel, came down, came back up, and then came back down to the bottom of the channel, and then that's when we consolidated into this tighter channel. So all of this that I just talked about is technicals. Fundamentals is more like things that you would see in the headlines and stuff with different things going on with the company, or like I said, what their books look like and stuff on that. So that concludes part one. Part two, I've already touched on, and part two is short-term versus long-term. Now, if you're buying stocks with no intention of selling, at least not for a period of time, then you are what's considered an investor. If you look at the company's balance sheets and you look at what the company's doing and you take all of that into account and you want to buy shares of a company for the dividends and to hold them for a long time, that's investing. So I have a long-term portfolio, and I even have a portfolio for my son Elijah that we buy stocks in, and that's investing. I'm not day trading. I'm not getting in and out of the trades in the same day or same week or same month. I'm buying on red days and letting it go. And if you're an investor, now could be a really good time to pick up some good cheap stocks. Tesla's been selling off, Apple sold off, a bunch of other stocks have sold off over the last couple of days, and now could be the time to buy. But the risk of investing is when you have days like this, if you bought up here, and I've actually seen some people talking, they just bought Tesla yesterday or the day before, and then it sold off really bad. And with investing, you have these swings like this, and it happens in every market crash. People are buying, stocks are up and up and up, and then bam, and it wipes out, in this case, 6 days. In some cases, it's years worth of progress in one quick crash like that. So that's one of the cons of being an investor. Now, short-term trader is someone that's in and out in a day or a couple of days or a week or a month. There's no intention of holding the stocks long term. And anytime you're buying an option or dealing with options, you're pretty much a trader because you can't really invest in options because they have an expiration date. Unless you're using it to get the shares at a good deal or something like that, then that would be considered into the trading the investing category. So a trader, anybody that was investing today pretty much lost money. My long-term plays that I have, even though I'm not investing, but my long-term plays lost me money today. Now they'll bounce back because I've got some that go out, next year and stuff. So, they have plenty of time to bounce back, but we'll just have to wait and see what tomorrow brings. And another thing that I want to talk about, this brings me to my third point, and then I'm going to touch base on a couple of different things here, is your risk tolerance. And some people are very risk averse. Some people are okay with risk. My wife is very risk averse. She wants everything safe, secure, simple. Me, I'm a little bit more on the risky side. If the numbers are showing me something, then I'm going to do it. So, for instance, today and yesterday, I took a big risk because these red lines here that you see is where I trade these credit spreads. These were put credit spreads, but I drew this line out to see where the stock could have went or where I could have pushed it to in a condor in order to collect more premium for the same collateral. And I'll cover condors in another video. But you can see this line here that I drew. It should be extended out to this candle, but where I drew it on the daily, it's just not showing on the 4-hour. I would have lost, if I went into a condor, I would have lost money on this trade yesterday because it was above 357 at the close. So this pushed the envelope there. So I didn't do it and I've been testing. You see, I've not done any condors in the short term down through here. So I've been testing that, trying to figure out what I wanted to do for my parameters to start trading the condors to collect. You can collect about 50% more premium. If I'm selling this play here, I might have got 30 cents, but I could get like 49 cents if I sold the condor side of it, depending on how tight I pinched it, which I've been dealing with $6 spreads here, is what I've been running this time. And you can see the majority of the time, these never go and close above the line that I drew. So the majority of the time it would have worked, but that one would have been close there. But this time it wouldn't have. But I did sell a credit spread above because I had this wedge pattern going on. I had the overbought going on. I had the extension off of the EMA. We were at the top of my channel. I had all signs pointed to yes in this case. So I did sell a call credit spread instead. And I'm going to go to my tracker. Because everything pointed in the way that it did, I took 5 contracts. I've not sold more than one contract during the bulk of this, except for on the 28th. I sold 3 contracts on one and 2 on another, which was 5 total, but it was still far apart from what this is here. So here you can see the stock was at 357.85, and I sold a 361 call on it. So it only had $3 to move. So it was kind of tight. I collected $30 in premium for each one. And then obviously today that it worked out in my favor, and the stock opened up down and proceeded to drop further. And I wish I'd have sold another one down here today instead of letting it come down a little bit. But the market did seem like it had legs this morning for a little while, and it was kind of a pump, and then it sold off real hard, and then it kind of bounced back and then sold off again. So I sold another 5 today for the 353 level that it again expires tomorrow. So if I come back over here, we're sitting at 345, and so it would have to come all the way back up to here in order for me to hit where I sold at. Now it could do it. I mean, this covered $12 today, 355 to 345.10, and then it came on down here. So it can do it. I'm not saying it can't, but I don't believe it will. Because it's at the bottom of this channel, though, it could. And if you're dealing with Fibonacci retracements, which is another technical analysis term over here, this actually, I'll throw a fib on here real quick. Where's my fib? There it is. With a drop, we dropped from here down to here. So a Fibonacci, we could retrace to the 618 would be at 350. To the 786 would be right at 353. So we could retrace a good bit tomorrow. Even whoops, there we go. We could retrace a good bit tomorrow, but I still should be okay with the one that I sold. Futures. Let's see, the futures right now. We're down on the futures a little bit. So if we have a rally tomorrow, then it could come back up. But right now, it's looking like we're still going to stay around the bottom of that channel, if not maybe sell off just a little bit more. One thing I want to touch on real quick in the small account, this is up a good bit, but I did put another $1,000 in this account today. I just transferred it in today, so it's not all gains there. I'll show you the history here, so you can see I did transfer in $1,000 today, but we are up. I've transferred $1,000 to actually set the account up, and we had the one free stock for like $6, and then I transferred another $1,000 in. So we've made $300, $390 on the account, 200 of which is today, and it was up more throughout the day. But what I did is I bought a SPY put today, and it ran really good. And let's see, the SPY put that I sold, it's not going to show down there. Can't remember which one I sold now. All right, SPY. That's where I opened it. 347 put. So I bought the 347 put for $93. I bought one of them, so it was 1% of the or 10% of the account almost. And then I sold that one for $357. So I bought it for $93, sold it for $357. So I was up in profit pretty good there. So then I took those profits, and then I came back down here and I bought two $333 puts for $52. It went against me, so it lowered it down, but I still felt like it was going to drop more, so I bought two more at $42. And then I bought three more, averaging down. I bought three more at $26. So we have 7 contracts now on the SPY to go further south, and hopefully it will. And the total return right now, we're down, but we've been up and down through here. You can see it's been up to 53. Our cost is 38. So tomorrow, if it does open down, this one will be in the money. It's just when it pumps back up a little bit, everybody gets jumpy on the SPY, in my opinion, because it didn't move that much. But I also, in this account just got unlocked for spreads. So I sold call credit spread for this account as well. And this account, I was actually amazed that it got spreads approved within a week. So I started applying on Monday, and it just kept telling me I needed more trading experience. But on this one, we're up 56%. Total returns $54. We sold 3 of these. Yep, 3 of these. I sold 3 of these in the account, $32 in credit on each one. So $96 total, as you can see here. And we today made $54. If it drops more tomorrow and obviously expires tomorrow worthless, then we'll keep the entire $96 in the account. So this account's going good. I'm going to do another video detailing more about this account and our plans for this account. But this video's ran long enough, so I hope that you gathered something. In conclusion, from the video, fundamentals versus technicals. You can use both. Fundamentals and I don't know if I mentioned this. Fundamentals always overrides technicals. I don't care if the stock is at the top of the channel, at the bottom of the channel, if it's in oversold territory. I don't care if it's got a hammer candle. I don't care if it's gapped down today. I don't care what it is. If someone comes out and says something about the stock that makes everyone love it, the stock's going to take off. If someone comes out, if it's gapping up and running, and someone comes out and says something that makes everybody uneasy, it's going to sell off. Fundamentals always, always, always overrides technicals. So for part 1, fundamentals and technicals, you can use both. Fundamentals always win. Part 2, or point 2, short-term versus long-term. It's okay to have a mix of both. Short-term is obviously more flexible. If the market turns, you can close your positions and open new positions, for the bearish plays that are going on. And then when that's run its course, you can close those and open bullish positions. You can, as an investor, you can add to your position when the stock drops. And the last point is the risk tolerance, how heavy you want to go in a play. Like I said, normally I've only been doing 1 contract each in these, and then this time I stepped up to 5 contracts each because of what I was seeing in the charts on the 1-hour chart, and that was a risky play. It was more risk, but it's paid off thus far in the trades that I've done. So again, I hope you enjoyed this. I hope it was informational and not too confusing. And please subscribe, leave any comments you have below, share it with someone. Make sure to hit the bell notification so that you're notified whenever I put up another video. And hopefully we have a good day tomorrow, depending on which side you're playing in the market. So until the next time.